Imagine a world, and I don't mean some like sci-fi dystopia. I mean the reality for most of human history, where you're standing in a market.
Okay.
You have a brand new, beautifully stitched pair of shoes. Size 9, leather loafers, you made them yourself. But, well, you can't eat shoes. And your stomach is absolutely growling. You are desperate for wheat.
It's the classic economic survival dilemma, isn't it?
It is. So you start walking around the market shouting, "Who has wheat and wants size 9 leather loafers?"
Mm-hmm.
You find a guy with a mountain of wheat, but he just shakes his head and says, "Sorry, I need clothes, not shoes." You find another guy who desperately wants your shoes, but he only has clay pots to trade. It sounds exhausting, right? It sounds like a logistical nightmare.
It sounds like a full-time job just to get lunch.
Exactly. But believe it or not, that is how humanity started trading. Today, we aren't just talking about money. We are talking about the engine of development itself. We are decoding NCERT Class 10 Economics, Chapter 3, Money and Credit.
And this is not just about, understanding how a bank works or why we use paper notes. This is about cracking the code of the economy. It's foundational stuff that explains why some people stay poor while others get rich.
That's right. We are on a mission here, cracking the UPSC code. This deep dive is powered by the Simplified UPSC by PPP YouTube channel.
We're glad to have you with us.
Before we jump in, a humble request. If you find value here, please subscribe. If you are capable, support us on Patreon so we can keep bringing this super useful content to you.
It really does make a huge difference.
And we want to give a massive shout out to all our current supporters for making this content creation possible. You guys are the fuel in our engine.
Absolutely. We appreciate it more than you know.
Also, don't forget to like this video and share your valuable comments. We actually read them. And for resources, don't forget, free notes with practice PYQs, that's previous year questions, are available on our Telegram channel.
And for those who want to go deeper,
for access to all videos in this series at once, and organized premium notes, which include detailed notes, extra PYQs, and model mains answers, join the private Telegram library. DM on the public Telegram channel to join.
All right, housekeeping done. Let's get into the meat of it.
Let's set the stage. Why this chapter? Why are we spending an hour on something that seems so, every day?
So money and credit sounds basic, right? We use it every day. We swipe cards, we scan QR codes.
Yeah, it feels intuitive.
But in the context of the Civil Services examination, this is a foundational block for General Studies Paper 3, specifically the economy section. But it doesn't stop there. As we go through this, you'll see massive overlaps with GS Paper 1, particularly regarding society and the feminization of agriculture.
Oh, interesting.
And GS Paper 2, when we talk about governance and self-help groups.
So it's a multi-paper heavy hitter.
Yeah.
It's one of those topics where if you understand the core mechanism, you can answer questions across the board.
Exactly. We're going to cover the evolution of money, how the banking system actually multiplies money, which is a bit of a magic trick. The two faces of credit, the asset versus the debt trap, and that critical distinction between formal and informal lending sectors.
And just to be clear on our sources, we are strictly decoding the NCERT Class 10 Text Understanding Economic Development, Chapter 3.
Right. But we're also linking it to actual UPSC mains questions from 2014-2020 and others to show you exactly why this stuff matters.
Perfect. Shall we go back in time?
Let's do it.
Let's do it.
Yeah.
Section 1. The evolution of money from barter to fiat. Let's go back to my shoe problem.
Right, the double coincidence of wants.
That's the technical term, right? It sounds a bit romantic. Double coincidence.
Chuckles. It's anything but romantic. It's a massive, massive barrier to progress. In a barter system, goods are directly exchanged without the use of money. But for that to work, you need that double coincidence.
The perfect match.
The perfect match. What a person desires to sell is exactly what the other wishes to buy.
Which, as we established, is incredibly difficult. It relies purely on chance.
It completely limits trade. Think about it. It keeps an economy small and local. You can't trade with the next village if you don't know what they want.
You certainly can't build a complex supply chain.
Absolutely not.
Yes.
You can't employ 1,000 people if you have to pay them in shoes, and they all want different things. This is where money enters the chat. Money acts as an intermediate step.
It's the middleman that everyone actually likes.
Precisely. It acts as a medium of exchange. It eliminates the need for that double coincidence. The shoe manufacturer doesn't need to find a wheat seller who wants shoes.
No, he just needs to find anyone who wants shoes.
He exchanges the shoes for money. Then, with that money, he can go to anyone selling wheat.
It sounds so simple, but that really revolutionized human interaction. It decoupled buying from selling.
It allowed for specialization. for cities, for civilization, really. But money itself has changed forms drastically over the centuries. It wasn't always coins and paper.
The text gives us a fascinating timeline on this.
It does. In the very early ages, Indians used grains and cattle as money.
Imagine paying for your coffee with a handful of wheat or a cow.
Well, maybe not a cow for a coffee, but for a plot of land.
Sure.
It worked because those things had intrinsic value. Everyone needs to eat. A cow produces milk. They were assets.
But they were hard to carry around. I mean, you can't put a cow in your pocket.
Shekels. And they die. They aren't durable. And they vary in quality. One cow isn't exactly the same as another cow. There's no standardization.
Right.
Exactly. So we move to the metallic phase. We see punch-marked coins, which are some of the earliest coins in India, dating back maybe 2,500 years. Then came the Gupta coins, often called the golden age of Indian numismatics. Then you have Tughlaq coins, Akbar's gold moher.
The text references images of these. Gold, silver, copper. These were valuable because the metal itself was valuable. If I had a gold coin, I was holding a piece of gold.
Right. If you melted down a gold coin, you still had a lump of gold. It had intrinsic value. The face value, what was stamped on it, matched the value of the metal.
But that brings us to the weird part. Modern currency. Paper notes.
Fiat money.
Yeah. I mean, look at a 100 rupee note. It's just paper. Or a 10 rupee coin. It's not gold. It's not silver. And it's certainly not edible like the grain or cattle. So the text raises this critical question. Why is it accepted? Why do I give you a valuable service or my hard work for a piece of paper that costs pennies to print?
It's a fantastic question, and the answer is a combination of trust and authority. Modern currency is accepted as a medium of exchange solely because it is authorized by the government of the country.
So it's valuable because the government says it is. That's it.
Essentially, yes. In India, the Reserve Bank of India, the RBI, issues currency notes on behalf of the central government. And this is a monopoly. As per Indian law, no other individual or organization is allowed to issue currency.
So if I start printing deep dive dollars in my basement, that's illegal.
Highly illegal. You'd be in jail very, very quickly. And there's a legal framework protecting the rupee. The law legalizes the use of the rupee for settling transactions.
Meaning what exactly?
It means no individual in India can legally refuse a payment made in rupees.
That's a super important point.
Yeah.
So if I owe you debt and I offer you rupees, you cannot sue me for not paying you in gold. You have to accept the rupees.
Correct. That legal backing is what gives a worthless piece of paper the power to buy a house. That is the definition of legal tender.
I want to double-click on this history part for a second because I think it's fascinating. The text mentions these specific coins, Gupta, Tughlaq, Akbar. Why does the NCERT specifically list these? Is it just for, like, historical flavor?
It's not random at all. It actually tracks the economic prosperity and, more importantly, the state capacity of India through the ages.
Okay, how so?
Well, when you look at the Gupta coins, often called the Golden Age, those coins were high-purity gold. The imagery was sophisticated. It showed a wealthy, centralized empire that controlled resources and had skilled artisans.
And then Tughlaq. His story is famous.
Infamous, maybe. Muhammad bin Tughlaq is famous in history for his currency experiments. He tried to introduce a token currency, brass and copper coins that were supposed to have the same value as silver coins.
That sounds suspiciously like modern fiat money.
It was. He was way ahead of his time in theory, but it was absolutely disastrous in execution. He failed because he couldn't prevent forgery. People started minting coins in their houses because the design was too simple and the state didn't have the authority or the enforcement mechanism we talked about earlier.
So everyone became their own central bank.
Exactly. And the economy collapsed. It's a perfect historical lesson in why authority and trust are the absolute bedrock of modern currency. If you can't trust that the piece of paper, or in his case, copper, is unique and backed by the state, it becomes worthless.
Speaking of government authority and paper notes, the text actually takes a detour into a major recent event, demonetization.
Yes, it specifically mentions November 2016.
Right, when the government declared the old 500 and the 1,000 rupee notes invalid. Just like that.
That was a massive shock to the system. The text uses it to illustrate a few things. First, the absolute power of the government to define what is and isn't money. One day it's legal tender, the next day it's just scraps of paper.
Yeah.
But secondly, and more importantly for the long term, it highlights the push toward formalizing the economy.
Because people were forced to put that cash into bank deposits.
Exactly. And that accelerated the move toward digital transactions. Checks, ATM cards, point-of-sale machines, and of course now UPI. It's about reducing the reliance on physical cash, trying to control corruption, and bringing that black money into the white formal system.
It's interesting how money is becoming less and less physical. But let's stick with the banking system for a second, because most of our money isn't actually cash in our wallets. It's just a number on a screen.
That brings us perfectly to Section 2, the banking system, specifically demand deposits.
Okay, let's unpack this. I get my salary. I keep some cash for buying milk and veggies, but the rest goes straight into the bank. Why do I do that?
Well, safety is the primary reason. It's safer than under your mattress. But also, banks pay you a small amount of interest. But the key definition here is demand deposit.
Meaning I can demand it back whenever I want.
Exactly, because you can withdraw it on demand. And because through checks and digital transfers, you can use that balance to make payments directly, these deposits are considered money.
They constitute money in the modern economy.
Yes. A check is just a piece of paper instructing the bank to transfer money. A UPI transaction is a digital instruction. It acts as money. But here is where it gets really, really interesting. What does the bank do with your money?
I used to think they just put it in a big vault with my name on it, like a Harry Potter Gringotts situation, maybe a dragon guarding my 5,000 rupees.
Chuckles. That is the common misconception. If they did that, they couldn't afford to pay you interest. In fact, they'd have to charge you a storage fee.
So what's the reality?
The reality is something called fractional reserve banking, though the NCERT text simplifies it very nicely as the 15% rule.
The 15% rule. Okay, explain that.
Banks in India hold only about 15% of their total deposits as cash. This is a provision to pay depositors who might come to withdraw money on any given day.
Wait, only 15%? So if everyone who deposited money with a bank came back on the same Tuesday to get it?
The bank would collapse. That's called a bank run. The text actually poses this as a thought experiment. What would happen if all depositors asked for their money at the same time?
Chaos. Complete chaos.
Chaos. But statistically, that doesn't happen. On any given day, only a small fraction of people withdraw. So the bank takes a calculated risk. They keep 15% for liquidity and the remaining 85%.
They lend it out.
They use the major portion of the deposits to extend loans.
And this is the fundamental business model of a bank.
It is.
Mhm.
Think about the spread. They pay you, the depositor, a very low interest rate, maybe
Okay.
3% or 4% on your savings account.
Right.
They charge the borrower a much higher interest rate, maybe 8%, 10%, or 12% for a home or car loan. The difference between what is charged to borrowers and what is paid to depositors is the bank's income.
So banks are basically middlemen between those with surplus money, the depositors, and those who need money, the borrowers.
And in doing so, they actually create money. This is the multiplier effect I mentioned earlier.
Okay, let's double click on this creation of money bit, because I think this is where people get confused. How can they create money if they are just lending out what I gave them?
Okay, let's trace the rupee. Imagine you deposit 1 lakh rupees in Bank A.
Done.
Bank A keeps 15,000, which is 15% in its vault, and lends the other 85,000 to a guy named Raj to buy a car.
Okay, so Raj takes that 85,000 and pays the car dealer.
Right. Now, what does the car dealer do with that 85,000? He's not going to keep it in a shoebox.
No, he deposits it in his bank. Let's call it Bank B.
Right. Now, Bank B has a fresh deposit of 85,000. Do they keep it all in their vault?
No, they've followed the 15% rule too, so they keep 15% of that.
Exactly. They keep about 12,750 and lend out the remaining 72,250 to someone else, maybe to renovate her house.
Who then spends it, and that contractor deposits it in Bank C, and so on.
Yes. So look at what happened. You still think you have 1 lakh in the bank, which you can access.
I do.
The car dealer thinks he has 85,000 in his bank, and the third person has 72,000 in loan cash. The original 1 lakh deposit has supported multiple economic activities.
So that original deposit of mine is basically being used in 3 or 4 places at once.
Exactly. This is how banks create money supply. The physical cash is small, but the money circulating in the economy is much, much larger.
That is genuinely mind-blowing. So the money supply in the economy is actually much larger than the amount of cash the RBI ever printed.
Much, much larger. And that's why the banking system is the heart of the economy. If banks stop lending like in a financial crisis, the money supply shrinks dramatically and the economy chokes.
And that's why the health of banks and their non-performing assets, or NPAs, is such a huge topic in UPSC GS3.
Precisely. It's not just about bank profits, it's about the liquidity, the lifeblood of the entire nation.
Okay, so that leads us perfectly into the next big topic, the borrowers. If banks are lending, someone is borrowing. Section 3. the two faces of credit.
This is so crucial. We often think of debt as a bad word. Don't get into debt.
Yeah, it has a negative connotation.
But in economics, credit is neutral. It's just an agreement. I give you money now, you promise to pay me later. Whether that's a good or a bad thing depends entirely on the outcome and the risks involved.
The text gives us two brilliant case studies to illustrate this, the asset versus the debt trap. Let's start with the happy story. Salim.
Salim is a shoe manufacturer. It's the festival season. He gets a massive order for 3,000 pairs of shoes to be delivered in a month.
That's a huge opportunity, but he doesn't have the cash to buy the leather or pay the workers today. He's cash poor, but order rich.
A classic business problem. So he uses credit. He obtains credit in two clever ways. First, he asks the leather supplier to supply leather now and promises to pay him later. That's trade credit.
Okay.
Second, he takes a cash advance from the trader who placed the order as part of the deal.
So he leverages the order itself to get the capital.
He does. He produces the shoes, delivers them on time, gets paid in full, and then repays his loans.
And he's left with a nice profit.
A very nice profit. In this case, credit plays a vital and positive role. It allowed him to capitalize on an opportunity. It increased his earnings. Without credit, he would have had to turn down the order and his business would have stagnated.
A clear win. But then we have Swapna.
Swapna's story is heartbreaking and unfortunately very, very common in rural India. Swapna is a small farmer. She takes a loan to grow groundnuts on her small plot of land.
Now, unlike Salim, whose risk was maybe the order getting canceled or a worker strike, Swapna's risk is nature.
It's nature. Farming involves incredibly high uncertainty. In her case, pests attack the crop. She tries to save it with expensive pesticides, which adds to her costs and her debt, but the crop fails anyway.
So now she has the debt, but zero income to pay it back.
Correct. The debt just grows with interest. The next year, she has to take a fresh loan just to cultivate again. Even if the crop is normal that year, her earnings aren't enough to pay back the old loan and the new one.
She's caught.
She is caught in what we call the debt trap. To repay the mounting debt, she has to sell a part of her land.
So instead of helping her increase her earnings, the credit has actually made her worse off. She lost her primary asset. She went from being a landowner to potentially landless.
This is where we need to connect the dots to the UPSC mains. This isn't just a story.
Yes, let's bring in the PYQs.
Look at the 2014 GS paper I question. It's Q14, and it asks about the increasing feminization of agriculture.
What does that mean exactly? Feminization of agriculture.
It means that as men migrate from villages to cities for work, women are increasingly left behind to manage the farms. Swapna represents this vulnerable group. Female farmers often lack access to formal credit, they lack technical support, and they lack safety nets. So when a shock hits, like pests or a drought, they fall into the debt trap much faster because they don't have the resilience that a larger, perhaps male-dominated commercial farm might have.
That makes Swapna's story not just an anecdote, but a symbol of a huge structural problem in our society.
And let's look at the modern context. The text says crop failure due to pests. But if we look at today's news, we have to talk about climate change.
That wasn't a PYQ, but it's a huge theme.
It absolutely is. Swapna's risk profile is changing. It's not just pests anymore. It's unseasonal rains, it's droughts, it's heat waves. Her risks are multiplying.
And how does that affect the debt trap?
It makes it systemic. If it's just one bad year, maybe she recovers. But with climate change, extreme weather events are becoming more and more frequent.
So if she faces a drought in year 1 and a flood in year 2?
There is zero chance of recovery. The debt trap transforms from an individual tragedy into a mass social crisis.
Which leads to the horrific issue of farmer suicides.
Unfortunately, yes. The high indebtedness of rural households is one of the leading causes of farmer suicides in India. The NCERT story of Swapna is sanitized, but the reality is incredibly grim. This is why schemes like crop insurance, the Pradhan Mantri Fasal Bima Yojana, are so critical. They're trying to take that risk factor out of Swapna's equation.
And look at the 2020 GS paper I question, Q9. It's about how the pandemic accelerated class inequalities. Compare Salim and Swapna in that light.
It's a perfect illustration. Salim had access to the market. He was part of a formal supply chain. Swapna was at the mercy of nature. Economic shocks affect classes very, very differently.
Yeah.
The Salims of the world, who have access to formal credit and markets, can often ride out a storm or even profit from it. The Swapnas, who rely on nature and informal debt, get wiped out. The debt trap is a primary driver of poverty and inequality.
That is such a powerful distinction. So What determines whether you end up a Salim or a Swapna? A lot of it seems to come down to the terms of credit.
Correct. That's Section 4. Not all loans are created equal.
What exactly makes up a loan? The text lists 4 pillars.
First, interest rate. This is the obvious one. How much extra do you have to pay back?
Okay.
Second, documentation. Do you have salary slips, income tax returns, proof of identity?
Third is the mode of repayment. Is it a monthly installment, a lump sum at the end?
And fourth, and most critically for this discussion, collateral.
The great barrier.
Collateral is an asset that the borrower owns. It could be land, a building, a vehicle, livestock, even deposits with the bank that acts as a guarantee. If you default on the loan, the lender takes your asset.
And this is the fundamental reason why the poor can't just walk into a bank and get a loan.
Exactly. The text gives the example of a woman named Megha taking a housing loan. She gets 5 lakhs at 12% interest. But she has to submit her employment records, and the bank keeps the papers of the new house as collateral until the loan is repaid.
So Megha has a job. Megha is buying an asset, a house. She has paperwork.
Swapna, the farmer, might not have clear land titles. A daily wage earner has no salary slip. Without collateral, the formal banking system, the system with the low interest rates, closes its doors to you.
Which forces them to knock on a different, much more dangerous door.
The door of the informal sector.
Section 5. Formal versus informal sectors of credit. This is, in my opinion, the most shocking part of the data in this chapter.
It really highlights the dual economy of India. On one hand, you have the formal sector, banks and cooperatives, all supervised by the RBI.
And on the other hand, the informal sector. Moneylenders, traders, employers, relatives, friends.
Now look at the statistics provided in the text. There's a graph that breaks down loans for urban households.
For rich urban households, 90% of their loans come from formal sources. 90%.
They walk into a bank, show their collateral and their ITRs, and get a loan at 8.5% or 9% per annum.
But for poor urban households, it's the complete opposite.
It is. 85% of their loans come from informal sources.
That is a staggering divide. The rich get the cheap money, the poor get the expensive money. It seems completely backwards.
It's expensive to be poor. The cost difference is just brutal. The text mentions a small farmer named Shamal.
Right, let's look at his numbers because they are jaw-dropping.
Shamal borrows from a village moneylender. The interest rate is 5% per month.
Wait, 5% per month? That's 60% per year.
60% per annum. 60. Compare that to a bank, which might charge 8.5% to 10% per annum.
So Shamal is paying 6 times more interest than a rich person in the city, just because he's poor and lacks collateral.
And it gets worse. Sometimes he borrows from a trader at 3% per month. Still a whopping 36% per year. But there is a condition attached.
What's the condition?
He must sell his crop to that trader after the harvest.
And the trader probably pays him a lower price for the crop than the market rate.
Exactly. So the trader makes money on the high interest and makes money by buying the crop cheap. It's a double whammy. It's exploitation.
This high cost of borrowing explains exactly why the poor stay poor. A huge chunk of their income just goes to paying off interest.
In many cases, the interest payment is greater than the principal income they generate. This is the very definition of the debt trap. You are working just to service the debt, not to live, not to improve your life.
We talked about the interest rates of the moneylender. But there's a social aspect to the informal sector too, right?
The text mentions relatives and friends as a source of credit. That sounds nice on the surface. A friendly loan.
But money can ruin friendships and family ties.
It absolutely can. But consider the employer as a lender, like a brick kiln worker borrowing from the owner just to feed his family.
This often leads to bonded labor, doesn't it?
Exactly what it leads to. You take a loan to survive, you work to pay it off, but the wages are pitifully low and the interest is high. You can never pay it off. So you are bound to that employer. You lose your freedom of movement, your freedom to choose work.
So credit in the informal sector can actually infringe on your fundamental rights.
It intersects directly with Article 23 of the Constitution, the prohibition of traffic in human beings and forced labor. That's why the RBI and the government are so desperate to push financial inclusion.
Right.
The Jan Dan Yorana wasn't just about giving people a debit card. It was about trying to break the shackles of the informal moneylender and the cycle of bonded labor.
Now, we mentioned the RBI supervises the formal sector. What does that supervision actually look like?
The Reserve Bank of India is the watchdog. It monitors that 15% cash balance we talked about to ensure bank stability. But more importantly, it ensures that banks don't just lend to big profit-making corporations and cities.
This is the priority sector lending mandate.
Yes. The RBI mandates that a certain percentage of bank lending must go to the priority sector. Small cultivators, small-scale industries, small borrowers, education loans. Banks have to submit periodic reports. Who are you lending to? At what rate? If they don't meet these targets, they get penalized.
So who watches the moneylender?
Absolutely no one. There is no organization that supervises the credit activities in the informal sector. They can charge whatever they want. They can use unfair, often violent, means for recovery, intimidation, violence, harassment.
It's the Wild West of finance.
It is. And this leads to a major policy argument for your mains answers.
Which is?
Cheap and affordable credit is crucial for the country's development. If we want to pull people out of poverty, the formal sector must expand its reach, especially in rural areas. We have to reduce the dependence on these exploitative moneylenders.
But how? We come back to the same problem. If they don't have collateral, banks won't lend. It's a catch-22. We can't lend to you because you're poor, so you have to stay poor.
It was a catch-22 until someone came up with a brilliant ground-up innovation.
Section 6, self-help groups or SHGs. The solution.
This is one of the most successful developmental models to come out of South Asia, and it's celebrated globally. The idea is simple.
Okay.
If one poor person lacks collateral, maybe 20 poor persons together can create a substitute for it.
How does an SHG actually work? What's the structure?
You organize 15 to 20 members, typically women from the same neighborhood or village. They meet regularly, maybe once a week, and they save.
How much do they save?
Very small amounts. The text says anywhere from Rs25 to Rs100 per person, whatever they can afford. But the key is that they do it regularly and consistently.
So they build a small pool of their own capital.
Yes. And initially, members can take small loans from the group itself for urgent needs.
At what interest rate?
At a reasonable rate. It's decided by the group, but it's much, much lower than the moneylender's rate. But the real magic happens after a year or two of regular savings.
Okay, what happens then?
The group becomes eligible for a loan from a formal bank. This is the SHG Bank Linkage Program.
But wait, they still don't have collateral. They don't have land titles. Why does the bank suddenly agree to lend to them?
Because the group is the borrower. The loan is sanctioned in the name of the self-help group, not an individual. And the group dynamic acts as the guarantee. If one member defaults or runs away, the other 19 women in the group know they have to cover it, so they ensure everyone pays their installment on time. Peer pressure becomes the collateral.
That is genius. It uses social capital to access financial capital.
Precisely the term. And the impact is massive. The loans are used for everything from buying seeds and fertilizers to buying a sewing machine or a cow, or even releasing mortgage land from a moneylender. It helps them build productive assets.
I love the SHG topic. The text makes a point that it's not just about money.
It's so much more. It's about empowerment. And we need to link this to the PYQs again.
Let's go back to that 2014 GS1 question, Q14, about the sociocultural forces driving feminization of agriculture.
SHGs are a direct response to that. They organize rural women. They give them a platform, a collective voice.
The text says they meet and discuss social issues: health, nutrition, domestic violence.
Imagine a woman who was previously isolated within her home, completely dependent on her husband or the local moneylender. Now she handles money. She sits in a meeting, she makes decisions. If she faces domestic violence, she now has 19 other women standing behind her for support. That is social empowerment through economic means.
And looking at the 2016 GS2 question, Q11, about the effectiveness of government systems and people's participation.
SHGs are the ultimate example of people's participation. It's not the government just handing out cash. It's people saving their own money, managing their own loans, and the government, via the banks, stepping in to support that self-driven effort. It's participatory development at its finest.
And finally, there's another question about urban poverty and distributive justice. I think it's for 2025 GS1 Q8.
While the NCERT text focuses on rural SHGs, the principle is the same for urban poverty. Distributive justice means giving the poor access to resources. SHGs give the poor access to the most vital resource of all, capital. Without capital, you can't start a small business, you can't improve your skills, you can't escape the daily grind. SHGs provide that first rung on the ladder out of poverty.
It's a silent revolution, isn't it?
It is. It happens quietly in small circles of women sitting on the floor, counting 10 rupee notes, but it completely changes the power dynamics and the social fabric of the village.
So let's wrap this up. We've covered a lot of ground here.
We have. Let's do a quick recap of the key takeaways for anyone studying for the exam.
Okay, takeaway number 1. Money makes trade easy. It kills that inefficient double coincidence of wants.
2. Banks are not just safes. They are money multipliers through the loan deposit mechanism and that 15% reserve rule.
3. Credit is a tool. It can be a ladder to prosperity, like it was for Salim, or a trap that pushes you deeper into poverty, like for Swapna. It all depends on the terms and the risk.
4. The informal sector is largely a predatory system. It charges sky-high rates to the people who can least afford it, keeping them in a cycle of debt.
And 5. SHGs are the bridge. They allow the poor to cross from the abusive informal sector to the secure formal sector, using the power of unity and social collateral.
And remember, knowledge is wealth, but only if you apply it. For a UPSC aspirant, this means you don't just write SHGs are good. You write SHGs substitute social collateral for physical collateral, thereby correcting the market failure of the formal banking system to serve the rural poor. That is the winning answer.
Boom. That's the difference right there. That's the analysis that gets you the marks.
And before we go, I want to leave you, our listeners, with one final thought to mull over.
Go for it. A provocative one, I hope.
We talked about paper money, we talked about bank deposits, but the text itself mentions the 2016 demonetization and the rise of digital transactions. We are rapidly moving toward a cashless or less cash society. Central bank digital currencies, or CBDCs, are already being piloted.
So are we heading toward a future where money as a physical object just disappears entirely?
And if so, what does that mean for the unbanked poor we just discussed? If you need a smartphone and a stable data connection to spend money, does the digital divide become the new financial divide?
That is a scary and incredibly important question.
Digital payments make transactions easier, for sure. But do they make credit easier? Just because Swapna has a smartphone doesn't mean the bank will suddenly give her a loan without collateral.
Unless we start using digital footprints as the new collateral.
Exactly. You're thinking about things like account aggregators, cash flow-based lending instead of asset-based lending. That is the new frontier. If Swapna generates a consistent stream of data by buying seeds digitally or receiving payments through UPI, maybe that data trail itself becomes her collateral.
Wow. From barter to Bitcoin to data as collateral. What a journey.
It is the story of civilization, really, told through the medium of exchange.
And it all starts with Chapter 3 of NCERT Class 10. Who knew it was that deep?
Now you know.
Cockles. Now you know. All right, everyone. Thank you so much for sticking with us for this deep dive.
It's been a pleasure.
Once again, a humble request. Please subscribe to Simplified UPSC by PPP. If you are capable, please consider supporting us on Patreon so that we can keep bringing this super useful content for you.
And a big, big shout out to all our supporters. You help us create this content. We really couldn't do it without you.
Don't forget to like this video and share your valuable comment. We want to hear your take on that digital divide question. Is it a threat or an opportunity?
And grab the resources we mentioned.
The free notes with practice PYQs are available on our Telegram channel. To get access to all videos of this series at once and their corresponding premium notes, that's the detailed notes, extra PYQs, and model mains answers in an organized way, join us on the private Telegram library. Just DM on the Telegram public channel to join.
Keep learning.
Keep questioning. We'll see you in the next deep dive.